Hello everyone. Thank you for joining us today for our mid-fall update. As usual, our focus will be on the current market and economic circumstances which we find ourselves in. We'll also discuss what we believe will be the theme for investment management for the rest of 2020 and into the early part of 2021. It's always our hope that you and your family are doing well, and despite the second wave of COVID, you are finding time to enjoy what can at times be a beautiful season here in Canada. My name is Mark Tokar, co-founder and portfolio manager here at Accilent Select. The markets have responded with strength, but we have a sense there's a lot of hot air as opposed to real substance keeping them afloat. We'll update you on thoughts about COVID and the potential for further lockdowns, the current status of the Canadian economy, the implications for mounting debt, and what the resulting few months will have in store for the North American economy. We'll then explore the alternative space, general market performance, and finally our portfolio performance. COVID transmission is now in an exponential growth phase. Hotspots are accelerating around the world. As of late, the US added 1 million cases in under 1 week. Worldwide, there are 56 million cases with 1.35 million deaths. The US amounts for almost 20% of all cases around the world. And with a Biden administration, we anticipate that the US may face more rigorous distancing and lockdown provisions. Pfizer and Moderna have announced vaccines. However, no FDA approval has yet been awarded, and there are potential infrastructure issues related to the distribution of these vaccines. Europe is also undergoing a further spike that is dwarfing the initial spring wave. In Canada, capacity utilization, which is the measure of the percentage of assets being used of a nation to produce its goods, has fallen steeply with little rebound. Unemployment spiked to over 14% during the initial wave of the pandemic, but on the backs of government intervention has come down below 10%. Inflation remains non-existent, although we remain watchful of the massive amounts of money being pumped into markets to prop them up as a potential catalyst for future inflation. Unless Canada can manage the second wave of COVID, we anticipate that unemployment will begin to increase as business closures will begin to accelerate. Gross debt to GDP is worrisome. This chart shows the ever-increasing future tax burden that will be expected to be paid back by taxpayers as a result of government revenue shortfall and accumulated deficit spending. Canada's debt to GDP has deteriorated quickly. Canada had one of the most robust and expensive responses to COVID relative to other nations. Our ranking doesn't improve much when we compare ourselves to G20 nations either. Debt burden has become top of mind for us when it concerns the future outlook for the Canadian economy. Unprecedented government spending has added stability to both the credit and equity markets, and has produced a surprisingly resilient employment number. Canada has seen a drop in its unemployment rate back to 8.9% as of the end of October. However, that represents an increase of 3.3% from last year. Our concerns are with independent businesses. The Canadian Federation of Independent Business conducted a survey of its membership regarding bankruptcy. The response is bleak, with 14% of its respondents admitting to actively pursuing bankruptcy as of the middle of October. We feel that this number may rise to just below 20% by year end. The result will have wide-ranging implications for all aspects of the Canadian economy. Looking at our US spotlight, fiscal recovery programs, supported by massive Fed stimulus, has led to overall rising incomes during a recession, which is unprecedented. This has led to a big lift in automobile and housing sales. Unemployment has ebbed from extreme levels, but is still very high. And consumer sentiment is low, but stock market sentiment is a bit frothy, particularly when it comes to mega-cap growth stocks. As seen here, Overall, rising income during this recession has been due to government transfer payments, which practically doubled to over 30% of total income earlier in the pandemic. This, in turn, has encouraged spending on two important big-ticket items, cars and houses. Automobile sales have rebounded sharply to approach levels once seen at the end of 2019. And home sales, remarkably, have surpassed previous year levels and in fact recorded new highs for the economic expansion that began in 2009 after the financial crisis. A desire for more space and work from home employment brought on by the pandemic, along with sub 3% 30-year fixed mortgage rates, have resulted in a flight to the suburbs and big spikes in sales of both new and existing homes. Questions still remain as to sustainability of economic growth, as unemployment, although having receded from depression levels, remains at levels associated with recessions in the United States. Complicating this employment picture is that the higher levels of unemployment are despite a lower participation rate. And participation rate really just measures the percentage of employable persons that are still actively looking for work. This metric has declined to its lowest level in over 50 years, a time when a great many, if not most, U.S. households relied on just one income. So despite there being some improvement in consumer sentiment from pandemic lows, it remains well below the levels that indicate confidence in the future outlook for the economy. So what's really puzzling is that the stock market sentiment shows a willingness to throw caution to the wind, and it continues to progress further into greed territory. Based upon Warren Buffett's famous quote, "To be greedy when others are fearful and fearful when others are greedy," the current picture would suggest a little dose of caution is in order here. It wouldn't be too far from the truth to say that the stock market is suffering from a split personality complex. Take a look at this chart here. What we're showing are 10 megacap stocks known as the FANG index. Facebook, Apple, Amazon, Netflix, Google, plus 5 other actively traded technology stocks, depicted here by the black line in this chart. And they're all trading at price to earnings valuation multiples that are extreme and that haven't been seen since the internet bubble of the late 1990s. At the same time, there's what we call the Dividend Aristocrat Index, which is depicted here by the blue line on the chart. And it represents about 65 companies that have grown their dividends for at least 25 years, have basically been ignored by the current investor base. And this type of narrow focus and disregard for valuation is, in our view, a signal for some caution here for investors, but also it's an opportunity for savvy investors who've maintained a little bit of cash on the sidelines to now start picking up great name companies that have grown their dividends, have been ignored, and take advantage of some great valuations. Due to the low interest rate environment, we believe that it is extremely important to keep an allocation to alternative investments. Our view is that central banks around the world will be forced to keep interest rates at zero or negative for the foreseeable future. There are two ways to manage the debt. The first one is to try to pay it back through austerity measures and painful deleveraging process that would lead to bankruptcies and an insolvency crisis like the deleveraging period of the Great Depression. The other, less painful option is to inflate the debt away, and some central banks have already signaled this by stating that they will let inflation run above their 2% target rate. With nominal interest rates already at zero or negative, this means that currencies will slowly be debased, effectively inflating the debt away over time. Hard assets such as gold and real estate would perform well in this environment. This is a very similar playbook to post-World War II debt management. Have a look at the cost of a stamp around the middle of the 40s and then 20 years later, and you'll see exactly what type of circumstance we're headed for. Our gold stocks have done well this year. We will keep this allocation for reasons mentioned in the previous slide. However, over time, as the investment pays off, we'll look to trim positions if gold tends to run higher. Trez Capital is a mortgage bridge lender primarily operating in the U.S. The fund performance year to date is positive at 5.6%. However, given the low interest rate environment, we believe that it will be difficult for the manager to keep these returns without providing mortgages to projects with higher risk profiles. And therefore, we may be looking to replace Trez with more of a stable real estate position. Rise REIT is a REIT that operates in Seattle. The year-to-date return has been 1.62%, and the fund has encountered a higher vacancy rate than usual due to COVID-19. However, they do have a very strong balance sheet, and we believe 2021 will yield better returns. Alignvest Student Housing specializes in the acquisition and management of student housing in Canada. They own 8 properties at 4 universities. The year-to-date return has been 10.7%. To date, the portfolio is 84% leased, and they expect the vacancy rate to drop by mid-2021 as more students return to school. On the whole, markets around the world remain negative, with a few exceptions. U.S. markets have rallied strongly, buoyed by the flood of money seeking an alternative to zero interest rates. Bonds have responded strongly this year, posting almost 9% return. However, there is potential for danger on the horizon for anyone holding bonds, as we see both credit and default risks mounting. Gold has also made an extraordinary charge on the backs of fiscal and monetary stimulus. We anticipate that the yellow metal has found a new floor price range in around the $1,800 value. Our portfolios have done well against their respective benchmarks for the year. As always, our clients dictate our approach, as many are pre-retired or retired, and are seeking less volatility with modest returns. On a composite basis, and that's calculating an average return for like portfolios, our portfolios have achieved better performance than their benchmarks with less risk. To summarize, markets aren't necessarily reflecting the reality of the situation at this time. Bay Street and Main Street are delivering 2 different messages. Certain growth stocks may have gone too far, too fast, and may potentially face the risk of repricing over the course of the next couple of quarters. There is definite risk of a double-dip recession if vaccine rollouts and lockdowns don't curb the impact of COVID. Volatility has subsided for now, but that can change almost instantaneously. As such, we're playing defense with client portfolios, but we'll also be adding to positions that demonstrate strong fundamentals and good dividend growth. As always, we welcome your calls. If you have any questions or would like to set up a time to discuss how we can help you with your investment, please don't hesitate to contact us. Thank you, and we'll be in touch soon.